Welcome back to another episode of Life Lessons with the Laceys. Today we're going to talk about taxes.
Wow, nothing like jumping right on in, but it was a highly requested topic because let's face it, nobody gets taxes. Okay, so before we begin, we want to be really clear we are not tax professionals, and we don't even pretend to play one on TV. So we're going to talk to you like we would talk to our own family, and we're going to share with you the things we've learned over the years of being a grown-up, but you should consult an actual professional for any real advice.
Okay, so now that we're done with that, let's get to it.
Alright, so we'll be as efficient as we can, but there's a lot to unpack here. So we're going to talk about credits and deductions, we're going to talk about marginal tax rate, we're going to talk about how to fill out your W-4s, and then how to get organized when it's time to file. So here we go. Okay, so we're going to talk about how to fill out your W-4 for your first real job in a minute. But before we get there, we have to lay a little bit of foundation. When you file taxes, it's an equation between how much money you've made and then how much tax you owe on that. The problem is there's all sorts of factors that change how much your answer is versus somebody next to you. So when you're filing taxes, there are two things that will affect how much tax is taken out. One is credits. Credits are things that directly reduce the taxes that you owe. They're pretty much like coupons, but for taxes. Deductions, on the other hand, reduce your income, which in turn reduce your tax obligation. And that's really helpful too, because it's going to essentially pretend like you made less money, and then you don't have to pay as much tax because you don't have as much income. There are a pile of credit options and a pile of deductions too, but there are definitely ones that are more common. Some things that you may have heard about or you'll see are earned income credit. That has to do with both your income range and how many children you have. A thing that may very well apply to you soon as a student is the lifetime learning credit. You can have a credit for any fees or books that you were required to purchase from school. However, the maximum that you can claim in 2019 was 20% of $10,000 or a $2,000 credit. And then you can also have credits for your kids. So you get $2,000 per child in 2019. Don't kid yourself though, kids are still really expensive. On the other hand, you've got deductions. So deductions may not apply a ton when you are first newly working, but as you get settled into your grown-up life, some of these things will definitely apply. So you have medical and dental expenses. Especially if you don't have medical insurance, you might find that you are exceeding more than 7.5% of your income, and then you can deduct your expenses. Once you've bought a house, you have property taxes and mortgage interest, and both of those things are deductions. If you're making retirement contributions or contributions to a health savings account, those are also deductions. And then another huge one is charitable donations. So whether that's a house of worship or to the Goodwill, those all count in deductions. One of the things to know that is an option is that you can either, for deductions, take what is called a standard deduction, or you can itemize. And the real answer for that is you just take whichever is higher. So a lot of us, especially people who don't own a house, don't have enough deductions that add up that make sense to itemize. That total ends up being lower than the standard deduction, but it's always smart to check. In 2019, as an individual, your standard deduction was $12,200. And what that means is that right off the top of your income, we've taken off $12,000, and that new number is what you're going to be taxed on. So this is an illustration of how $3,000 can behave pretty differently depending on if it's a credit or a deduction. If we take somebody who has made $50,000 and they owed $6,800 in taxes, and then give them a $3,000 credit, that is like a coupon. So it's going to reduce their tax obligation down to $3,859. If you take that same person who had $50,000 and give them a deduction instead, that makes a new income of $47,000, and then that brings their tax obligation to $6,200, which is almost a difference or a little bit more than $2,300, which is pretty significant. So now we have that behind us, we're going to talk about tax brackets. You'll hear people talk about that a lot, and they have a lot of stress because they're jumping a tax bracket. When you hear the word tax bracket, you're really talking about the marginal tax rate, and it doesn't work like you think it works. People think that because they've jumped into the 22% tax bracket that all of their income is being taxed at that rate, and that's not really true. I like to think of tax brackets like pockets. So you start at 10%. All of the income that you make up to $9,700 is taxed at 10%. If you make more money than that, you move into the next pocket. Any income between $9,700 and $39,475 is taxed at 12%. You fill that pocket up, you move into the next pocket. Now my income between $39,475 and $84,200 is taxed at the 22% rate. And then if I have income beyond that at $84,200 through $160,000, that's taxed at 24%. All of these numbers are based on 2019 single filing rates. So let's say that you've made $9,000 this year. You're at the 10% tax bracket, you're under that $9,700 bracket. This is pretty easy. $9,000 times 10%, you owe $900 in tax. Pretty straightforward. But let's say that you now make $20,000. That pushes you out of that 10% pocket, and now you have income that's filling into that 12%. So it's going to look like this. The first $9,700 is taxed at 10%. That's $970. And then $9,701 through $20,000 is taxed at 12%. You add those two figures together, and you're paying a little over $2,000 in tax. It's important to note at this point, though, that that is an effective tax rate of 11%. If I take your $2,200 and divide it out into $20,000, you're paying 11% of your income in tax. So let's take that a step further. What if you're making $50,000? Now at this point, you are out of the 10% and out of the 12% pockets, and you've moved some money into the 22% pocket. So a lot of people think that they see that 22% and they think that this is what's happening, that your $50,000 is times 22% and you're going to owe $11,000 in tax. But that's really not how it works. Now you have three pockets. Your first $9,700 still taxed at 10%. Your $9,701 to $39,475 is taxed at 12%, just like we did a second ago. And then everything that's beyond that, so $37,476 through your $50,000, that's what's taxed at 22%. That ends up being another $2,700. So if you make $50,000, we take those three figures together, and you owe $7,200, almost $7,300 in tax, not $11,000. For the record, that turns out to being about an effective tax rate of 15%. So yes, we're paying more tax than we were at $9,000, but you're not paying anywhere near 22% even at 50. Okay, so now you've gotten your first job, and it is time for you to fill out your W-4. Your W-4 is where you decide how much federal and state tax to withhold from your paycheck. You really do want to get this right. If you withhold too little, you're going to have a big bill in the spring, or if you withhold too much, you're going to have given the government a big loan of your money for free all year long. So this is what your W-4 looks like. It can be a little intimidating at first, but we're going to go right through it. The first thing that you need to choose is your filing status. Withholding rates are different depending on if you're single or married, so you want to choose whatever applies to you. Next, you're going to choose the allowances that you're claiming. I don't know why they call it allowance instead of dependents, but that's really what they're talking about. So do you have kids or other people who are depending on you financially? You would claim them here. If it's just you, you're going to say 0 in this box. You can claim or withhold rather an additional amount each paycheck if you'd like. You might do this if you're consistently owing money in the spring and you don't want to be surprised by that bill. But for most of us, the answer is no. And for the record, if you do need to save extra money, I'm a big fan of that happening in your own bank account versus the government's. And then you need to decide whether or not you are exempt from taxes. And as much as you might like to say yes to this, sorry, you really probably aren't. There are very limited exceptions, and nearly all of us have to pay taxes. Then you're going to sign and date it, and you're done. You give this back to your employer, and they will start withholding the appropriate amount from your check. As we wrap up, I just wanted to share with you a document that I created a couple of years ago that helps me keep track of our family's finances and the things that I need for filing our taxes. It makes our filing easier, but more importantly, it reminds me of what I'm looking for in the mail each year. It becomes kind of confusing. There's a lot of mail that comes in, and it's easy to lose track at tax time. So I'm keeping track of things like the mortgage interest that I'm paying, and my student loan interest, and the taxes I pay to our village and school and county. And then recently I started to add some other things that were kind of helpful for our family finances. Things like, when is the car loan going to get paid off, or when do our passports expire? Having everything be in one spot has been a real time saver more than once. So I hope that you feel a little bit encouraged that you can do your taxes. There are a bunch of free or nearly free options to e-file. Once you've organized your documents, the computer program really pretty much walks you right through it. Or you can put all your stuff together and take it to a tax professional. That's absolutely a thing lots of people do. You got to do all this work anyway, so truly the difference is, are you going to do it and tackle it yourself, or are you going to pay somebody else to help you through it? Sometimes it's easier to have somebody help you the first couple of years, and then you have some confidence, and then you can tackle it on your own. Remember, we are not tax professionals, so please consult a certified professional for actual real advice for your actual real life.
Thanks for sticking with us, friends. It's not a surprise. I don't do our taxes. I'm sure none of you are shocked by that. I will say my big contribution is watching the mail. A lot of these things come through the mail, and you have to get them, and you have to keep them in the same place. So I watch the mail. I make sure when I see something that I know is a tax document, I put it where she can find it. So when we're ready,
spot? No, you got to pick a spot.
Yeah.
You pick a designated spot, and that's where it goes.
Yeah. So all of it needs to go in the same basket. It comes at different times. And don't be surprised, your employers have till the end of January to mail out your W-2s for you. So sometimes you don't get them until the first or second week of February, and a lot of people worry that they don't have them yet. It can take a couple of weeks for them to get here.
We tend to do our taxes, I'm usually doing them about mid-February on a good year. You'll see all of those pop-up places happen in January, but you don't have all your stuff yet. So it's too soon. Mid-February-ish, but you've got time. You've got all the way to the middle of April.
Yeah, you've got till April 15th, unless that falls on a weekend. If April 15th is on a Saturday or Sunday, you'll have till the following Monday to file your taxes. So you totally can do it.
Thanks for sticking with us today. Till next time, bye.